also similar kind of a popularity have and very much practical. That is called marginal costing. Okay. So standard costing method is basically we go for the actual activity and we find out what is the difference between what we have decided and what we have actually done. Just like in the beginning of semester, you have planned your semester that how much marks you are going to achieve. So you have set the standard that I will achieve 85% marks or 90% marks. And accordingly, you do the preparation, all the budgets, all the preparation you do according to your standards, which you have set for the first semester. But once the exam is over, once the actual exam comes and you write your exam, once the result comes, then we will see that what the standard you have set and what actual performance you have done. Is there any difference? If yes, then this difference is favorable or unfavorable. This difference is good or bad. Okay. If your marks above your standard, so we can say your performance is good. If your marks is below the standard, so we can say your performance is not good. Same way in cost accounting, we follow this method where we, before the production, before the activity, we have decided that what should be the cost set, and then find out whether it is difference. If yes, then difference is positive or negative. Okay. Okay, so somebody is asking about the glossary link, so I'll share it at the end of the session, no problem. So if we look at the definition of this standard costing, so we can see that the planned unit cost of product, component or service produced in a period. So that particular method is applied for the certain time period, or we can say that it will be defined for the chunk or the time period, and then once the time period is over, then we go for the next schedule. So the standard cost may be determined on the number of bases, and the main use of a standard cost is in the performance measurement. So basically, through the standard costing, we are checking the performance or measuring the performance of the business, that how we are actually producing. So the standard first we set, and then we go for the actual production and we check the differences. The differences could be favorable or unfavorable, and that method or that process is called variance analysis. So that we will also discuss. The standard cost has a two component. The first is to set the standard, and the second is to check the variance, which is the difference we have found out, and the analysis of that variance. So what is the process of standard costing, which is very simple. First of all, you have to set the standards. So first step to set the standards for your production process, that, okay, in the next month, how much I'm going to manufacture. So what should be my cost? What should be my material requirement and the requirement of the labors and all everything, whatever the cost related to the products is required, we will set the standard. Then we will go for the actual production. Once we decided everything, then we will go for the actual production. So we will identify what was the actual production or what was the actual cost and what was the standard we have set. And then we will do the comparison. And definitely there will be a reason, there will be a variance. It is rarely happened that there is no variance. Whatever the standard you have set and what you have actually done, it is similar. It has happened. It may happen, but very rarely. There's high chances that there may be a variance. Okay. So that variance has to be investigate. What is the reason of variance? So variance could be positive, favorable for the company, or negative or unfavorable for the company. So whatever the variance is, for every variance, we have to investigate the reason why it has happened. And then we will apply these investigations in the next process so that the variance can be sorted out. And that is how the cycle continue in entire life of the company or the for upcoming manufacturing process. So when we talk about the variance, so variance could be at different level. As we have discussed in the previous lecture that cost has a, okay, there's a one questions coming again and again, SEMA. Okay. SEMA is a international body of management accounting. Okay, so just like in India, we have ICAI, ICWA. Have you ever heard this kind of institution in India, Balaji? ICAI, ICWA. So in India, accounting bodies, accounting regulators are there. Okay, so ICAI is responsible body for accounting standards, policies, regulations. Similarly, the SEMA is an international body, okay, who is deciding the cost-related regulations and methods, okay. No problem if you're not from the commerce background, so it's not necessary. But I'm just giving you the idea that what is SEMA is as compared to or making comparison with Indian bodies, okay. So in India, we have an Institute of Chartered Accountancy, Institute of Cost and Workers Accountancy, okay, Institute of Company Secretary, okay. So similarly, there's a foreign body is called SEMA, or there are many other bodies there like CMA in USA, CPA in USA, okay, ACCA in European countries like this, okay. Yes, now Arnab has given the perfect explanation. It is an international watchdog, or you can say the regulatory body. Watchdog is not going to be would be the correct word, but regulatory body or the policymaker or the regulator who set the accounting and management related regulations. Basically, management accounting related, not accounting only. Management accounting, cost and management accounting related regulations. Okay. Okay. So I was talking about the variance class. Don't. So the variance is different based on the different levels, like at level of material, level of labor and overheads. I hope you remember this. I hope you remember this classification of cost, material, labor and overhead that we have already discussed in the previous lecture. And I particularly emphasize this particular classification because this is going to be used everywhere. Wherever you go through the cost accounting or any topic of cost accounting you refer, you will find the classification of cost will be you find there at the base of material, labor and overhead. Okay. So that is why I have emphasis in the previous lecture that you must learn the element of cost. It is going to be utilized forever in cost management accounting. Now, when we talk about the variance, so variance could be happen at material level, or it could be happen at labor level or overheads. So it may possible everywhere. But the question is how we will identify the material. So material is defined as price variance could be possible and the usage variance. Suppose when you are setting the standard, the price was different. When you go for the actual production, the price was different. A reason could be anything, but there is a price difference happened between standard cost, standard setting and actual production. So the variance happened due to price change. The usage is also happened where the consumption has been changed, and this usage has a two reason, the mix variance and yield variance. So there are some material which are mixed together to find out a particular output. So where we are going to mix 2 to 3 kinds of raw material to find out or to manufacture one item. So the mix variance could be possible. The quantity may change, and based on that, the output is going to change. Yield variance is means when the input is less and the output is more than the input. It may happen in the certain cases, not in all the manufacturing process, but in certain manufacturing where the inputs are providing you the yield. Yield means if you are using less quantity and you are getting higher quantity of output, or vice versa. Okay, where you are putting high quantity of input but as output you are getting less. So this yield variance could also be reason for the material cost. Similarly, in the labor case, the labor rate may change the variance. The rate which you have decided, but when you go for the actual production, the rate which you have given to the labor is different. It might be higher, it might be lower, that is depend. Efficiency, the labor efficiency is also a very big reason of creating the labor cost variance, because we don't know that what is the efficiency of labor. Sometimes labors are very much efficient, sometimes they are average, sometimes they are very poor. So the labor makes labor idle time, labor yield. So different kind of reason is possible to create labor cost variance. Okay, Raman Singh is asking what is the variance? What is the literal meaning of variance, Raman? Variance is a very common term. Okay, forget about in the cost accounting point of view. As a layman, as a simple term, what is the variance? Change, or we can say the difference. Yes. So suppose in first semester, like you are in first semester, have you decided created any blueprint you have created for your first semester exam? So what standard you have set, Raman? What is your percentage? Roughly 80%. And to achieve this standard, you are working on it. Am I right? Accordingly, you are preparing yourself. Okay. Accordingly, you are giving time to each and every subject so that you can achieve 80 and above. But is there any guarantee that in actual exam you will achieve 80? Exactly 80? How many situation could be possible? How many situation could be possible in actual? You may go beyond 80, you may be less 80, or you may be at par. Three situations could be possible: above, below, or at par. At par is also one condition, my dear. At par means what you have decided, you achieve the same goal. Okay. So if you decided 80 and you achieve 80, there's no difference, no variance. But when you decided 80 marks or 80% and you achieve 85, there is a variance, there is a difference, but it is a positive or favorable for you. Am I right? But you have decided 80, but you achieve an actual 75. Again, there is a difference, but it is unfavorable. This difference is unfavorable. So that is the same thing happen in the companies when they decide the cost of activity we are going, they predict the cost. But in their case, if they cross the standard, it is not good. Okay. So suppose if you are going to decide that I'm going to manufacture a mobile and this mobile cost would be 100 rupees. I have decided based on my previous experience and the raw material which I'm arranging, I have decided the standard cost of 1 unit of mobile manufacturing is 100 rupees, hypothetically. But I have manufactured that same mobile in 95. There is a 5 rupees difference. But this difference is favorable or unfavorable? Yes, Isika, if there's no difference, no variance, so at past situation, there's no variance. So if you manufacture the mobile at 95 where the standard was 100, so this variance is favorable, because in cost accounting, below the standard is a favorable situation. If you below the standard, you are in favorable situation. If you cross the standard, then it is unfavorable situation. Because if you decided the cost of mobile $100, but you manufactured at 110, it is not good. It is unfavorable. So in both the scenarios, we analyze, we go through the analysis that why there is a difference, what is the reason for the difference, and the next time we will fix these issues to get more accurate answers in the next cycle. Okay, so that is the whole process of standard costing. Clear? Just like your preparation for the semesters, what you have achieved and what was the difference. Once you get the result, you will analyze why there is a difference. Why you score less, you will analyze. And in the next semester, you will not repeat those mistakes. Okay. And again, it is not possible that in the next semester you will not have a difference. But that difference may be favorable and that difference may be not favorable. That is depend. Okay. Okay. So that is the objective. Yes, Lokesh, the objective of cost accounting is to keep the cost of product low as much as possible. Okay. Because that is good for the company. If your product cost is low as much as possible, that is good for the company, for you. Okay. So how we will calculate the variance? Okay. That is the another situation where, okay, that, okay, Arjit Saha is asking semester process. So Arjit, don't worry, just it is now a time to study the semester. When the exam come, we will explain all more concern, but in favorable condition, you might be not that much concern. The reason of concern may be, a level of concern may be different, but again, you have to think and you have to see what is the reason of differences in both the scenarios. Okay, so material cost variance, we have a specific formula and you just need to put the formula to get the answer. So this calculation, variance calculation, is completely based on formula. Okay, so you can refer the formula, understood the formula, and then do the questions or do the numerical. What is the formula? Material cost variance is a formula is standard cost minus actual cost. What standard you have set, what actual you have done, the difference is called variance. But you might think how I got it standard cost and how will I get actual cost. So standard quantity multiplied by the standard price will give you standard cost. Actual quantity multiplied with the actual price will give you actual cost. If you represent in the alphabet, so you can represent in ASQ, SP, AQ, AP like this. Okay, so you can see the same kind of formula in your textbook is also there. Okay, so like this you can see here material price variance. So material price variance is, the formula is very simple. Standard cost of actual quantity. The actual quantity which we are using in production, what is the standard price or the standard cost of that quantity, and minus actual cost. So the formula is standard price minus actual price multiplied by actual quantity. Or you have alternative formula which is extended version, standard price actual quantity, actual price actual quantity, that we have seen in the previous slide, which I have already told you that SP is a standard price, AQ is a standard actual quantity, like this. So this is the formula based calculation. If you memorize or understood the formula, it will be easy for you to calculate. Okay. Same way, all the formulas are given in your textbook. I would request to please go through and refer your textbook and go through the formula. And I have given you the one small illustration over here just to explain you, but this illustration is not enough. You have to go to the study material and do more practice, more numerical, so that you will be understood that how the things are calculated. Okay, now Arnab has a question. Okay, for example, an organization set up a target that they will make revenue of USD 10 million at the year end. So at the year end, they will say, are they get it or not, if more of it. Okay, so Arnav, first of all, in standard costing, we are not setting the revenue target. Okay, we are setting the cost target. So we are bothering about how much would be the cost of the product. Okay, and how much actually we are putting or actually incurring, and how much standard we have set it. It's not about revenue. Okay, in financial accounting we bother or we concern about revenue. In cost accounting we only concern about to cost, how to control the cost, how to reduce the cost, how to analyze or determine the cost. Okay, Shivam, the first phase is going to over today, and the second phase of lectures will start very soon, maybe next week or 10 days. The lecture will start, the second phase will start. So again, you will have a 5 lectures. And if you want any specific topic to discuss in those lectures, so you can tell me, I will add those topics in the next phase. Okay, because I didn't get any request from your side that, sir, we want to discuss or we need to discuss this particular topic in the same lecture. So I didn't get any kind of such a request, but you have a choice from the syllabus. If you any particular topic you want to discuss in the next phase of live sessions, you can send me the request. I will add those topics in the next lecture. Okay. Assessment submission final date is 30th December. Okay. So all the assessment, all 6 assessment, there are 6 modules, 6 assessment, all has to be submitted before 30th December. Okay. So this is the small illustration. Standard and actual figure of product Z is provided. Standard is 50 unit. That how much quantity we required to manufacture product Z is 50 unit. But actually we have utilized only 45. So we can clearly see that the standard was 50, but we actually use 45. So there is a variance is there. If you look at the question itself, the variance can be visible. And we can also see this variance is favorable because the standard was 50, but we actually use 45. Material price was standard was 1 rupees, but we actually received the same material from the market. We arrange or we manage at 0.8 rupees. Again, it is a favorable signal. How we can calculate? Okay, so you can see the standard cost, standard quantity, standard price. What was the standard quantity? What was the standard price? That is 50 rupees. Actual quantity, actual price. Actual quantity, actual price, what is 36 rupees. Clearly visible, there is a variance of 14 rupees. If you want to see the variance at 2 different levels, at the level of price, at the level of usage, usage means quantity. So there's a difference at first is price level, the second difference at the level of quantity. We can do separate calculation. Again, you will see if you do the separate calculation, again, you will find out the answer is 40. 9 rupees is a difference of price. 5 rupees is the difference of quantity, and total is 14 rupees. Okay. Now, I would request to everyone, please refer your textbook and go through couple of questions. of standard costing provided in your textbook. And if you find any problem in any question, so you can discuss the same with me. But the practice is very much important. You at least 2 numerical must be done by yourself. Okay, so at least 2 numerical you have to attempt. Yes, this is the example of favorable. Vice versa is also possible. So that is why I'm saying that at least 2 to 3 numerical you have to practice your own from the textbook. Okay. Now the next topic is called marginal costing. Again, marginal costing is also very, very important chapter. It is a very, very important method of cost accounting, no doubt. And same way, it is very, very important chapter in accounting for manager from the account point of view, exam point of view, because you might have a question from the marginal costing. Okay. So how many of you understood the marginal costing? In economics, you have learned the marginal utility, I hope. Vivek, you can go to the chapter standard costing in the textbook. There you can find out. I'm not able to recall the page number right now, and I don't have a textbook right now with me. So I can't give you the page number right now, but you can find out the relevant topic via searching through the topic name, standard costing. In ebook, go to the search bar and type standard costing. You will jump into the direct same page. Okay. Or you can refer the index. There you can find out the topic name. Okay. Now somebody has also given, Divya and Ami has given the page number 152, 166. You can refer that. Okay. Now, my question was marginal costing. So you can see here, cost of producing one additional unit of product is called marginal cost. Suppose if you are manufacturing 100 unit and the amount of manufacturing 100 unit is X. So what should be the cost of manufacturing 101 unit? So when you are manufacturing additional unit, how much cost is going to be increased in total cost is your called marginal costing. Let's understand in detail. In marginal costing, there are too many concepts, or we can say there are too many techniques we are going to use. So this marginal costing comes under the concept of CVP analysis. What do you mean by CVP analysis? Cost, volume, profit analysis. So when we are manufacturing something, how we are going to analyze it? So we will analyze that manufacturing cost based on the cost and the volume and the profit out of it we are achieving. So the cost expenditure we are going to incur, or how much volume? Volume means quantity over here. And what is the profit we are making out of it? This is the entire called CVP analysis. It is a systematic method of examining the relationship between the change in volume of output, change in total sales revenue, expenses, and net profit. Everything which is interconnected to each other. And in order to do so, we have a certain techniques to do the same analysis. The first one is called marginal cost formula, marginal cost technique. The second is break-even analysis. And the third one is PV ratio, profit volume ratio. So with the help of these three techniques, we will analyze the CVP, cost volume profit analysis. So what is break-even analysis? Have you ever heard this term? Because in the first semester, you have economics. Am I right? You have a subject economics. And these terms, marginal cost, marginal utility, break even, these are coming from the economics. So what is the meaning of break even analysis? Somebody saying there's no profit, no loss. So this break even is the situation where the company do not have profit and they do not have loss. That means the mobile phone which you are manufacturing at 100 rupees, you are selling at 100 rupees. Okay. If there's one mobile phone which you are manufacturing at 100 rupees, your selling price of that mobile phone is also 100. So means in that business which you are doing, there's no profit, there's no loss. This is called break even. Is it necessary to know the break even point for every businessman, for every manager or every management must know? Is it compulsory to know the break even point? If we don't know the break even, then what will happen? Like you are in first semester, you all aware about what is the passing marks. And those who are not aware, they are still searching that what is the passing criteria, what is the passing marks. Am I right? Is there anyone who don't want to know that what is the passing criteria? What is the passing percentage? Whoever is writing the exam or whoever is in first semester right now, they are all for searching that how much is the passing percentage cutoff. If they are aware about, okay. If they are not aware, they keep looking and they keep asking whoever is they're near about, they keep asking what is the passing criteria, what is the passing percentage. Why you are searching for such kind of information? Because you want to know what is your line which you do not go below that. You always looking for the or you want to be above that line, so that if you are not going to be top scorer, at least you could pass. Okay. The same way in business, if you are not in top achievers of profit or 30-40% or 100% profit, still you are looking for what is the break even point, so that I will always try to be above that break even, so that I will not make loss. Because business is all about making profit. It's not about social cause. It's not about the something like. We are all there in the business to make profit. So we always try to be above the break even. Anyhow, we have to be above the break even so that we can make profit out of it. So that is why the break even is very important. And these break even is going to be changed as the scenario is going to change. It's not going to be always fixed, that once it is calculated, it will go lifelong. No. So it will change according to the situations and problems. So first of all, we'll talk about the marginal cost equation. You have to remember the one line equation. You always need to remember this is this. Sales is equal to variable cost plus fixed expenses plus minus profit or loss. If there is a profit, it will be added. If it is loss, it will be deducted. We don't know whether the business has a profit or loss. So we have put it both. As per the situation, we can keep it profit or keep it loss according to the circumstances. So this is the marginal cost equation which you have to remember. Now with this marginal cost equation, you can play around. How you can play around? Sales is equal to variable cost. You can pick it up this variable cost and put it here to the other side. So it will now sales minus variable cost which is together equal to this way. Can we do this? Hello? This equation can be represented in this way. Yes, we can play around. We can change the equation. Now, the sales minus variable cost is known as what is called contribution. So we can say the sales minus variable cost is known as contribution. So we can say the contribution is equal to fixed cost plus profit. We can say that. Now the next question is, what is contribution? Required. Shruti, what we are discussing here, it is all practical. It is applicable in real world. BEP, break-even point, marginal cost, is realistic things we are discussing. Okay. So nothing is historical we are discussing. Everything is practical. It is applicable in real world. Now, somebody is saying owner's contribution is okay. It's not owner's contribution. This term you have already learned, you already understood in financial accounting when we have discussed the financial accounting in module 1, 2, 3. There we have discussed this contribution with a different name. In cost accounting, we call it as a different name, but that is the same. What is the different name? You know this? What is this? Gross margin. What is this gross margin? Gross margin is called as gross profit. So this gross profit we have already discussed in financial accounting. That is the same thing we call it as a contribution in cost accounting. The nomenclature has been changed. In cost accounting, we call it as contribution. In financial accounting, we call it gross margin. Okay. It's a gross profit. So how the contribution is calculated? So that is the same, sales minus marginal cost, or we can call it as a variable cost. So in marginal costing, there are two costs in any business or in any product, variable cost and fixed cost. Am I right? If you are going to manufacture a mobile phone, so manufacturing a mobile phone has required two types of cost, variable and fixed. What are those costs which is variable and what are those costs which is fixed? Anyone? PPE, property, plant, equipment, machineries, tools, all are these fixed costs. Am I right? Rent also. But rent is defined whether the property or no. If you own the property, then there's no rent. So those things which are always there is a fixed cost, that is called property, plant, and equipment. Wherever the machineries, equipment, and plant you are using to manufacture the mobile phone is your fixed expense. And the raw material which is required to manufacture the mobile phone is called variable. So what are the raw material for the mobile phone? Mobile phone raw material is screen, chips, motherboards, camera, softwares, all the components which is required. So battery, RAM, app, glass, you know that what are the raw material. I don't need to tell you in detail. You know that everybody is using mobile phone, and now current generation is more intelligent than me to about the mobile phone. So no need to say. Okay, so you know that what are the raw material. So suppose if I'm manufacturing 100 mobile phone, accordingly I require 100 mobile phone. If I change my variable output, let's say I'm going to manufacture 500 mobile phone. So what is going to change? Only the variable cost is going to change. The plant machinery equipment is not required because they are sufficient and they are capable to manufacture mobile phone 500. But what is going to change? Raw material or variable cost. So in marginal costing, the cost is calculated based on the variable expenses because in any way the fixed cost is fixed. This is not going to change. So suppose your plant capacity is 1000 mobile per day. In that plant, if you can manufacture 1000 mobile per day. So whether you manufacture 0 mobile phone, 1 mobile phone, 100 mobile phone, 500 or up to 1000, your plant cost will remain the same, fixed. What is only going to change? Variable cost. The requirement of raw material will change according to the output. If the output is 10 unit of mobile, accordingly the raw material will be required. If the output is 500, your raw material requirement will change. But one thing is fixed, that is called property, plant, equipment, machine. They are not going to change. They will remain the same. So the marginal cost is based on variable costs, not fixed, because in any way the fixed cost will remain the same, that we can add it later on as it is without any calculation. So that is why in marginal costing, we always focus on variable cost, which is changing every time. So my concern, my focus should be on variable cost, which is changing in nature. Okay. Okay, I will give you the PDF. I will share the link of PDF of standard costing and marginal costing as a reference material that you can refer. Okay. If you want additional reference material, you can download. It's not compulsory, but though you are asking that, I will share it. Okay. So this is the formula of calculate the profit using marginal cost techniques. So what is the fixed cost? 3 lakh rupees. The plant, property, furniture, fixtures, whatever the plant cost is, 3 lakh rupees. Variable cost is 5 rupees per unit. So how many unit you are going to use of variable cost? Multiply with that. What is the selling price of your product? 10 rupees. How many units you are going to manufacture? 1 lakh. So 1 lakh unit multiplied by 5. So the 5 lakh is your variable cost. 1 lakh multiplied by 10. So you know that what is your selling price? This is 10 lakh rupees. This is variable cost. So 5 lakh rupees is your contribution. Selling price minus marginal cost. What is your selling amount? 10 lakh rupees. 10 rupees per unit. What is your marginal or variable cost? 5 rupees per unit. So your contribution is 5 lakh. This contribution is nothing but gross profit. From the gross profit, gross margin or contribution, you have to deduct your fixed expenses, which is anyway fixed or constant, which is 3 lakh rupees. So contribution is equal to fixed cost plus profit. So we need to calculate the profit because the fixed cost and contribution is provided. So how much the profit is? 2 lakh rupees. Okay. Same way you can do the analysis for break even. Break even is also formula based. Concept I have already explained that break even is all about no cost, no profit, no loss. Okay. Just give me a second. I'm going to share with you a link. Just give me a second. Before concluding the session, let me share the ebook for you as a reference, which you can refer for the numerical point of view. Theory is also provided. Everything is there in that ebook, but specifically the solved numericals are there, which you can refer. Okay. So just give me a second. Here is the link of one ebook. This is the standard cost ebook. I'm going to share a second link of marginal costing ebook. Here it is, the second link. So two links for two topics which we have discussed today, marginal costing and standard costing. Okay. So these are the two links. Those who are interested in reference material, additional reference material, they can refer that. They can use it. Okay. Now, somebody was looking for the glossary. Okay. So just give me a second. I'm also going to share the glossary link. Just a minute. So that I also shared today, that you can refer it for your practice purpose. Okay, so phase 2 will start very soon. We will notify you for the phase 2 live sessions. Till then, I would request to everyone, please refer your study material